Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by managing director and investment strategist Ryan Grabinski to talk all things markets. Ryan, how are you doing today?
I'm doing well, Ross. We're getting into the holiday spirit here, and I love it.
That's right, yeah, and I want to talk about some holiday spending here in a bit, but first, let's start with where we often do with you, which is to talk about either an upcoming earnings season, one that we're in, or one that we just completed. We're at the back end of 3Q earnings, and I wondered if you could give us kind of a quick recap and just your takeaways from that earnings season.
Yeah, certainly. So third quarter earnings season, I would say overall came in pretty strong. The number is going to be right around 7%. 7.1% was the last number I saw on a year-over-year growth rate compared to last year, which is well above the initial estimates at the beginning of the quarter and is even above the January 1st estimates for the third quarter. So overall, it was a pretty strong earnings season. I would say that some of the earnings growth that we saw during the third quarter was being borrowed from what analysts had initially expected would occur during the fourth quarter. So the fourth quarter number has come down quite a bit. It was initially around 11%, and it sits closer to 5% now. As far as 2024 goes, though, which is really what the market's going to be focusing on going forward, there hasn't been drastic revisions just yet. The EPS figure sits at about 245 for the full year, and that's kind of where it has been for the last several months. So no change to the 2024 estimate just yet, which is, I'm sort of viewing it from an optimistic lens.
Yeah, and look, earnings have come in better than expected, and I think another place that has been better than expected for most of this year and has driven a lot of the economic growth we've seen is the consumer. And so, we're recording this after the Thanksgiving holiday, Black Friday, Cyber Monday. We're starting to get some data about how those holiday, discounting and promotional seasons played out, and it gives some good insight into the state of the consumer. So, what can you tell us about how that went this year?
Yeah, I would say, overall, the consumer has continued to do what it's done all year, and it's continued to spend money. Depending on the data source that you're looking at, growth is anywhere from 3 to 7%. Adobe Analytics has data on this. They're showing growth is about 5%. Salesforce has data. They're showing growth about 7%. And then if you look at MasterCard spending, they're showing growth of about 3% during the holiday season compared to last year. So overall, the consumer is certainly continues to spend here. I will say, the question we kind of get more often than not is, will it continue into next year? And there's just a few anecdotes that I'll give you on that topic. The first is that the consumer, unlike the U.S. government, has actually done a pretty nice job terming out their debt. So if you think about household debt, 70% of that is actually related to mortgages, and consumers fixed their mortgages during the pandemic at low rates, call it between 3 and 3.5%. So the headline figure that we see on 30-year fixed rate mortgages might be indicative of future activity being not so strong, but overall consumers are continuing to be in a good position there. And then the other data point that I'll kind of touch on is if you look at revolving credit as a percentage of disposable income, certainly it is normalizing a little bit here. It's kind of sits at about 6.3%. But if you look prior to the financial crisis, there's certainly more room for this to expand. So I would say, the bottom line is that consumers do not appear to be tapped out just yet, but there certainly is likely going to be a moderation in their spending going forward.
Yeah, and to your point about the market starting to look at 2024 earnings, I think the question from here is, can the consumer keep this up in 2024? You've laid out a few reasons why that might be possible, but a big reason, in my opinion, that the spending has been able to continue is a strong labor market. We know the Fed wants the labor market to cool a bit. We're starting to see some signs of that. How do you think about the interplay of the labor market and the data that you're seeing on that with this consumer spending picture for 2024?
Yeah, from my perspective, the labor market is everything. If we sat here 2 weeks ago, I would say, hey, initial claims are starting to turn up. They're about 230, but just last week they came back down And so, initial claims are still low relative to history. The one indicator that sort of is flashing in my eyes is actually the labor differential from the confidence report yesterday. It historically has a tight correlation to the unemployment rate. And if you look at where that reading is now, it suggests that the unemployment will likely tick up over the next 3 to 6 months. And, this is probably too high, but it does point to an unemployment rate of around 5%. I think it's a little challenging to get there as quickly, but obviously we know that when layoffs happen, they actually happen pretty quickly. So we'll continue to watch that. That's probably the most alarming labor market chart that I've seen in the work that I'm doing here.
Yeah, and the labor market differential, that difference between those seeing jobs as hard to get versus plentiful, but again, it kind of comes back to this idea that the Fed wants the labor market to cool a bit to bring, wage inflation back in line with 2% price inflation. So a cooling of a labor market shouldn't be all that surprising, but as you say, it kind of where it ends or where it stops is going to be critical for 2024. So we'll certainly have you back on before then to talk about it. But Ryan, I want to thank you so much for the insight today. We always appreciate it.
Thanks so much, Ross. It was great chatting.